Now for our Bloomberg Quick Take, where we provide context and background on issues of interest. Is your asset manager good enough to beat the market? The $10 trillion invested in active management funds is a bet that the answer is yes, but more and more people are saying no. And so is the world's largest asset manager, BlackRock, which is paring back its active equities group and focusing more on what's known as passive investing. It's an approach endorsed by legendary investor Warren Buffett. Here's the situation. A little more than 1/3 of all assets in the US are in passive funds, up from about 1/5 a decade ago. In the first half of 2017, flows out of active and into passive reached nearly $500 billion. Vanguard Group, whose founder John Bogle created the first index fund for retail investors, has been a big winner from the shift, as has BlackRock. Some companies that specialize in active management, like Fidelity and Franklin Resources, they're slimming down. Others are merging or even closing. Passive investments are also threatening hedge funds, which have drawn fire for poor performance and high fees. Here's the background. These days, active investing often means putting money into mutual funds whose managers make case-by-case decisions. Passive investments track indexes, which are groups of securities that are alike in some way. Bogle created Vanguard's first index fund after realizing that because active funds charge higher fees, their actual performance would generally be worse than their index counterparts. So here are the arguments. A 2016 study by S&P Dow Jones Indices showed that about 90% of active stock managers failed to beat their index targets over the previous 1-year, 5-year and 10-year periods. Fees explain a significant part of that underperformance. In their defense, active managers say that the period since the 2008 financial crisis has been an abnormal one, with many stocks moving in lockstep. They say this is likely to diminish as interest rates climb and the market moves into an environment that will play to the strengths of managers who pick stocks and bonds. You can read more